Hello there, viewers. Today is Sunday, September 30th, 2018, and this video is going to be for those of you who are in my TSP or Thrift Savings Plan group, or other investors who want to know about the S&P 500, how it did in the third quarter of the year. I will be talking about both price performance and earnings performance. I'm mostly interested in the earnings, of course, as that's what forms the basis of a valuation system I use to know what the reasonable price range is for the index at any time. There's quite a few people always joining the group. We are now approaching 21,000 members. If you're not already in the group, I'll issue a caveat that you have to be a TSP plan participant in order to join the group. In order to be a TSP participant, which is basically a 401k type program, you have to be active or currently or former current or former member of federal civil service or military service. Having said that, I'm going to start going over the third quarter results. I'm going to only go over the part that will interest the general masses this time, and not break it up into two sides where like I did last time. Last time I did the first half of my presentation for the general investing public, and the second half was more for those who were who might have IRA accounts or taxable brokerage accounts or other types of accounts where you can invest in sector or industry specific ETFs or even individual company stocks. This video here, I'll only be talking about the S&P 500 and a little bit about the other funds that are part of the Thrift Savings Plan. All right, so having with that out of the way, let's I'm gonna go to the presentation here. Okay. The third quarter, as far as my data is concerned, only counts for what earnings were reported by companies in the S&P 500 and reported during the July, August, and September time frame. I don't care what fiscal quarter was involved. I only care about when they actually did report their earnings. Because anyway, this is a list of areas I'm going to cover. I'm going to start with the index-wide performance results. Then after I go over that, I'll go over the sector-by-sector earnings results, both expected, what I was expecting at the beginning of the year, as well as what they actually did. Not the beginning of the year, but the beginning of the quarter, and compare them to what they really did report during the quarter. Afterward, I'll talk about index price targets and valuation levels. These are the same. If you're in my TSP group, these are the same numbers that those are the same numbers you'll find in my announcement posts. I'll go over a little more detail on that so you guys can have a better understanding of that, because it's a common question that always gets asked by newer members. Not to mention question of where is the announcement post, and then what do those numbers mean when they are actually in it. So I'll go into more detail on that. After that, I'll look at the forward earnings growth projections for the index, so you have kind of an idea what kind of growth rates to expect in the coming quarters. And then after that, I'll go a little more at length with the bond yield information and comparison of bonds versus stocks. How some ways that you can compare which one should be more important to you and by how much. Lastly, I will show you the list of constituent changes that occurred in the S&P 500 during the Q3 period. Wasn't very active as far as that was concerned, but I'll show you more details on that when we get to that point. The point of this video, by the way, is mainly to show you information on the S&P 500 and then how it relates to the economy in some ways, and I'll talk about things that why certain area or certain data points in this presentation are important to me and why I think they should be important to you. And I also try to make distinctions between based on what type of investor you are, whether you prefer to be like a buy and hold type of who doesn't want to move your money any more than you absolutely have to, or if you prefer to be a swing trader like myself, where I like to actively move my money just for the fun of seeing if I can outperform the index or the stock funds that I'm trading. All right, so enough beating on that. I'm gonna go to the first part. This is the index-wide performance results. This one shows since I've been keeping this data from the midpoint of 2015 to now, gives you a good comparison of how strong the earnings performance has been quarter by quarter, and as well as how much positive or negative breadth, as I would put it, is there currently is across the index. Let me talk about the percentage part first, and I'm gonna elaborate a little bit more on that positive breadth part that I was just talking about. Okay, so the important thing here is the orange row here is the one that we just finished. There are actually 505 stock symbols in the index, but 500 companies. 5 of the companies have 2 share classes. Those companies are Alphabet or Google. I want to say News Corp, Discovery Communications, Under Armour, and I believe it's Fox Broadcasting. Those 5 companies have 2 different share classes. Both of their share classes are in the index, so that's why we have 500. Only 500 did report this quarter. The 5 that did not will be reporting early in October. 4 of those 5 will be reporting this coming week. 5 that have not reported were Paychex Incorporated, using the symbol PAYX. Then Lennar Corporation, or the home builder, which is LEN. Costco, COST. Constellation Brands, STZ. And lastly, Walgreens Boots Alliance, WBA. All but Walgreens Boots Alliance reports earnings. They'll report earnings this coming week, and then Walgreens Boots Alliance will be reporting in tentatively on October 11. So their data will be showing up in the Q4 results instead. So, all right, that in mind. Now, how did those 500 reports that we did get do? This change percentage part is what 26% is the important thing to take home from this, as well as this change dollar amount. It's not necessarily a dollar amount, but it's more of how many points on the basic value of the index that I use, or with my valuation system. Did it climb? Did the index climb or drop by during that particular quarter? So this quarter that just completed, in other words, my baseline value for the index, or as I call it, a zero growth value, or another way to put it is where would I value the index at if there were no earnings growth expectations to look forward to? If we were just in a flat environment, basically that number went up by about 154 points this quarter, or 26%. Those are very good, healthy numbers. As you see, the previous quarter, the change amount was slightly less by 148. 148 versus the almost 154 that we just saw, and that was with even more of the index accounted for, but the percentage was a little bit higher. And I think it's because of the raw numbers that were involved here in the comparison. So the big thing here for me is this column, the change dollar, because I'm more interested in what my baseline value gets changed by. But percentages are always good to see too. And as you'll see back here in early beginning of 2016, you'll see that we did have a period of negative growth in that particular quarter. We lost about 6 points in value that quarter. Overall loss of 1.13%. and naturally the S&P 500 in terms of its actual price performance did give very similar type of results then during that point in time. So the gains we saw from we've been seeing from stocks in over the last year, or actually since recovering from the correction that happened earlier this year, have been very well justified. But I'll go into more, with these following slides, and you'll get a better idea of what I mean, or what I mean by that, and why I mean that. But moving on to the other part of what part of this table matters to me is this positive versus neutral versus negative performance, or as I call it, positive breadth. The reason for this is because, good example, when the dot-com bubble popped in, what was it, 99 or 2001, whatever year it was, I forget the exact year. It was about a 2-year long recession that occurred, though, and when the tech bubble burst. During that point in time, there was a lot of talk about how only a few companies, basically the FANG type stocks back in that point in time, or at least the ones that really did exist at that point, there was a lot of belief that only those few companies were doing anything of any significance, and that the rest of the index was not performing, not given the kind of earnings performance that they should have been giving, and the price of the index, if you will, was artificially inflated as a result. So, considering that, I want to know the truth is here, how much of the index really is in good earnings health, and how much of it is not in so good earnings health. And that's where this positive, neutral, negative information tells me. So what I have from this last quarter is that 420 out of the 500 companies, or 84% of the entire index, reported positive earnings growth this quarter. And then by positive earnings growth, I mean this number here, the 745.19, just the quarter alone, that is in question. Compare that to the exact same quarter of the previous year. So comparing the 745.19 in quarter 3 of this year to the third quarter of 2017, we had 589.56. That's what this is basically covering. So and looking at a more individual basis, this is also what this involves here is basically 420 companies. Their quarterly earnings were higher this quarter than they were the same quarter a year ago. 8 more companies were about neutral. It might have been a little bit up, a little bit down, but because of rounding, we're talking usually billions of dollars, or sometimes hundreds of millions in cases with these S&P 500 companies. They could be higher, they could be lower, but like I say, for rounding purposes, they were roughly neutral as far as I'm concerned. 72 other companies reported negative earnings growth, or basically reported lower earnings this quarter than they reported last year. These are 84% overall is still a very strong number. As you see, the previous quarter of almost just about 86% positive breadth was the only quarter I have on record over the last 3.5 years that had a better amount of positive breadth and also a better percentage growth than the current quarter. So that tells you how strongly positive the last 2 quarters have been. If you go back quite a bit further to that same quarter I mentioned where we lost a little bit of value in Q1 2016, the percent positive at that point in time was only 52%. And out of 498 companies total, 259 of them reported positive growth, 15 were neutral, and 224 were negative. So at that point in time, it tells you that not quite as many companies in the index are increasing their earnings, and a larger amount were decreasing. Those are some red flags that can be looked for when there's concern about whether or not a recession and bear market are going to come. When you see numbers like 77%, almost 86, and 84% positive, and with double-digit positive percentage growths, yeah, I hate to say it, or I'd love to say this actually, but I hate to burst your bubble if you have one on this, but if you're not going to see a recession or bear market start with these kind of conditions. There's just no way about this. I don't care what other people try to say about, you never know when a recession's going to come. Well, usually recessions come and bear markets come after a snowball starts rolling, and it actually, and you can start seeing it impact more and more parts of the economy as it progresses. It starts to build up size and speed as it rolls downhill. So right now what we have is we're at the top of basically at the top of the hill in terms of growth rate. But we're going to keep growing over the next quarters, but expect it to slow down some, and you'll see that in the future, in the coming slides here. But my point to take home here, hammer home with this, is don't worry about a recession or bear market at this point in time. The earnings are definitely not supporting it. If we do see anything like a correction, at the moment is looking a lot like it would be an unjustified correction that would be highly likely to rebound back to normal at within a couple months, like the two of the last three did. All right, so let's move on to the next one. This is sector by sector earnings performance, actual versus expected. This is another one where if you're a TSP investor or just looking at a more broad, like a macro kind of oriented view like I use, this is meant more to give you an idea of how much positive breadth there is, or how much of the index is actually meeting or beating previous expectations, or the expectations that were present before the quarter started, to see how healthy the earnings performance actually has been this quarter. For those of you who invest outside of TSP and can invest in sector or industry ETFs or individual companies, this information can also help you, though. I'll explain that in a bit. But as you see, 500 of the 505 symbols reported, and you can see from these columns here which industry or which sectors, GICS sectors, or I call them GICs, reported how many companies are in that sector and how many reported earnings. Now these numbers, caveat, a few of these numbers are going to change because of the GICS realignment that just took place at the end of this week. I don't have that reflected in my information yet because I'm mainly looking at the trailing information. And that's another reason. That's one of the reasons why I'm also not going to show the sector and industry breakdown stuff that I showed in my previous end of quarter data, because I have to do that reorganization to put the companies that are affected by that realignment into the sector they're supposed to be in. So anyway, how can this be useful to you, the more broad-based or index fund type investor like the Thrift savings plan investor? Okay, so this quarter, at the beginning of the quarter, what I do is I manually transcribe these numbers from a different table that I use into here, and it tells me what each sector is expected to do over that quarter. And then this column here, the actual change, what it does is it automatically calculates what earnings were, or what kind of year-over-year earnings performance each of the companies in that sector did report during the quarter in question. And then at the end of the quarter, it can, I have that information and I can get a good comparison of how they did versus my expectations of them. The more the more sectors you see outperforming earlier expectations, the more healthy it means the economy is. And in this case, as you see, only one sector, the information technology sector, did not outperform or at least meet expectations. And I'm going to put an asterisk on that because that one negative, I didn't scrutinize the numbers, but it's highly likely that the fine that was levied on Alphabet or Google, which was a pretty sizable amount and did have a pretty good impact on what earnings they actually did report versus what they could have reported had they not been fined. I suspect that every bit of the difference that um, they could have had, that could have been made by not having that fine, probably would have wiped out this decline. So, in other words, it's highly likely that all 11 sectors outperformed expectations, which is a very good sign again for it's a very healthy, broad-based uh, growth that we're experiencing at the moment. I don't expect it to sustain itself, especially knowing that future quarters are supposed to slow down some. We will see some more red showing up, I'm sure, at some point, or at least the expected numbers lowering. But we can take whatever we can get here. The more positive and broad base we get with anything, the more support we have as a whole for the entire index. All right, next slide. Now we got our index price targets and valuation levels. As I mentioned earlier, these are the numbers that you will also see in the announcement post in the Thrift Savings Plan group. Now there's always questions about what do these actually mean. How do you work? How do you use them, or what do they mean? Should they mean to me, the investor, or whatever? And I'll explain that here. So right now, without any kind of forward earnings expectations factored in, only factoring in the last 12 months of earnings across the index, I currently have the value of the index at 2705 to 2730. So in other words, if we had flat earnings growth expectations, that's where I think the index would be valued. The index closed at 2913 at the end of the quarter, which is quite a bit, or a fair amount higher than what you see there, but there's a reason for it, and that's because stock prices are based not only on trailing earnings but also forward earnings expectations. So in other words, you're going to see numbers that are the actual price should usually always be somewhere in between where I have my current value and where my 12-month future value is, based on my experience of following this stuff. Now, what these values are, aside from the current value, now the future value, the 3-month, 6-month, 9-month, and 12-month, means this 2705 to 2730 range is expected to become those other numbers at that point in the future. So, by the end of calendar year 2018, I would expect that range to climb up to 2855 to 2885. At the end of March 2019, it should climb to 2970 to 3000, which you might notice is above the current price of the S&P 500 now. In other words, you're going to see more gains. You should be seeing more gains from the S&P 500 within the next 6 months for sure, or at least in all likelihood from what this information tells you. 9 months from now, which will be the end of June 2019, the value should climb to 3025 to 3055. And then a year from now, or at the end of September 2019, the baseline value should climb to 3090 to 3120. Now trading ranges, I'm going to go into more, I'm going to give you a chart view of what these numbers look like relative to the actual S&P 500's price right now, and but I wanted to explain the trading range information first. Okay, so trading range is more of a short-term view on where do I think the index is reasonably priced at this very point in time. It doesn't tell anything about which direction I think the long-term trend is going to be. Actually, the 12-month future value relative to the current price is what I think is what drives that, and I'll get more on that in a second here. But the trading range was meant more for those of you who swing trade, and you want to know what price points you might want to consider either exiting your stock positions from or re-entering them at. So the upper range, if you're a swing trader, this 2900 to 2925 is about the point where I would normally be selling out of my stock positions, even just temporarily. And wait for just a small drop. Volatility has been lower than normal recently. Yeah, there was a point, I think at the beginning of the quarter, where we did see a little bit more of the normal type volatility, but since the earnings season quieted down, it seems to be back to below normal. So normally the normal lower number here, 27.95 to 28.25, is where I would normally be trying to swing back into my stock positions, but we haven't been seeing that kind of volatility lately, if you probably noticed. So I haven't been waiting for it to drop nearly as much. I'm even happy with just a single percent advantage every time I do a swing. And right now the conditions have been pretty strong for the buy and holders. So as you probably noticed, I'm still not doing a heck of a lot of swing trading myself. I've been more of a buy and hold mode kind of guy, and then toward the latter part of the quarter, when there's less activity on the earnings front, that's when I start making a move or two. I did that once last quarter, and I did it again this quarter. But for the general investing population, I do not recommend swing trading. Most people are going to actually underperform the very same indexes that they're trying to outperform. This is to the tune of at least a good 99% of all swing traders underperform the underlying index. So that is a caveat if you do have an interest in swing trading. But if you do get really good at it and know exactly what you're looking for, what conditions, and makes wise moves, then you can potentially outperform it, not just short term, but even long term. But like I say, majority swing traders fail to perform long term, and most of them, I'm sure, do not even keep any kind of record of how they really are performing, nor do they likely compare it to the indexes. I know there are some who do, but most of the people I know who swing trade only look at charts and only basically look at what all these chart indicators actually tell them. Hey, buy here or sell there, and they don't make any significance at all of what the numbers are actually at when they make each move or how they relate. But if you're a buy and holder, if you're 100% stock fund buy and holder, that's one of those you really can't go wrong. Even if we have a recession and bear market come. Staying in a 100% stock fund, or a stock index fund, I should clarify there. Stay in that long term throughout your 30-year career or longer, whatever it ends up being. Trust me, you're going to get better results than you will if you go trying to jump back and forth between any kind of stock position, regardless of how much is actually in it, and jumping back and forth between there and the G fund because you see your account balance dropping or whatever. We'll go into that a little bit more, I think, on my conclusion anyway, though. But now, how do these valuations look as far as the charts are concerned? Let's come over to this. All right, this is the chart of the S&P 500. Actually, why are my drawings missing? For some reason my drawings are missing, but I'm going to show you how I can put those back in there. I think it's because of a recent update. Okay, so current value I have at 27.05 to 27.30. So I'm going to just put, doesn't matter where I put it, right? Just put it right there. Okay, so it makes this red line. I'm going to right click on it and hit edit properties. And I'm going to say current value 27.30 because that's the baseline of that range there that I'm working with. Now I'll just start this on May 1st. And I'm going to make this a white one. So I want there to be a distinction between what these lines all are. So, okay, so that's where the baseline value of the index is. Now I'm going to draw another one that'll represent where that, come on. going to draw another one for where the index will be a year from now, which is 31.20. I'm going to make that a yellow line. Oh, forgot to do something there. Okay, so I'm going to show the name on the left and show the price on the left, so you can actually see what the actual level is. And same with this one. In case you're wondering, this chart here, where am I getting this chart from? It's part of my Ameritrade setup. It's an app that I get actually, a program that I actually get from the Ameritrade website called Think or Swim. There are some other brokers who also use this platform. I don't know which ones they are, but I have heard that other brokers do use this same platform. Very, very handy tool. It's I usually like to call it the Photoshop of investing tools. Okay, now I'm going to put in my normal and upper trading range. So right now I got 29.25 as the hard upper. So 29.25. I'm going to go and leave that one red, and I'm going to make it a solid line because I want that to be the hard point. Now, this number specifically, if you notice, it's halfway between the white line and the yellow line. That is done on purpose. The reason for that, give you an little analogy. Let's just say if you had a project you wanted to have done at your home, and you needed, or maybe you had some repair work, whatever, and you needed to pay a contractor to do the work for you. Standard courtesy or expectation, whatever you want to call it, is that you pay the contractor for half the work up front, and then when they complete the work, you pay the other half. Think of stock prices as being about the same thing. We have a baseline level where it's already worth now without anything being done. And then if you have a project, or the project is earnings growth over the coming year for the companies in the index, this is going to become this value in the next year. So what we get is a price point, a reasonable price point up to about half of next year's value, and that's once it gets to that point, it shouldn't go any higher. It may sometimes do that. It does happen occasionally, and in fact, you'll see right here it did go slightly above, but there is some room for deviation. I'll explain a little bit. Okay, so 2,900. Put 2,900 in here, and then also show on the left. I'm going to leave this red also, but I'm going to change it to a dotted line. So that's telling me that when I get inside this range, me as a swing trader, this is the range where I'd normally be wanting to move out of my stock fund positions. Again, these are only short term, not long term. And so if you're a buy and hold type investor, do not try to make a move when you see this happen. Those kind of moves are meant only for, for someone like myself who likes to make short term type of trades. Come on. Okay, I must not have been hitting hard enough on the mouse. Okay, now I'm going to put the normal, let's say it's 28.25 to 27.95. 27.95 is the bottom end. Something else I forgot to do here was support, or short-term support. Oh, forgot to make it the color I wanted as well. I'm going to make it green. And here's my last one. Come on. Not sure why it gets a little stubborn there. It's a 28.25. Alright, so in other words, for a swing trader, if you're using this earnings fundamental style system that I use, I put the wrong date on it. Yeah. I normally make my moves out of the stop funds and this inside this red range between the dotted and solid red lines, and then I'll move back into stock positions when it gets into this green range. That only happens when we see a little more normal volatility, which on the chart will look a little bit more like what you see here. The candlesticks are a little bit larger, and from the peak to the bottom, they're also a little bit bigger. Now this is a little bit excessive here, but I think something a little bit more in this range is what I would call a little bit more normal. This is also a little bit close to normal here. This was the correction that happened at the beginning of the year, and what we're seeing here, you see these candlesticks are a lot smaller now, and when they go from peak to trough, back to peak and whatever, they mainly from peak to trough, they're not dropping very far before they go back up. So this is what I call lower than normal volatility. So I wouldn't normally allow the price to drop as far as I normally would before jumping back in if I'm going to do any kind of a swing trade move at all. Now, for those of you who are buying holders, who want to stay in your positions long term, this yellow line is the number that you should be interested in. Don't be concerned about the short-term behavior of prices. You see, it's going down a little bit right now. It does have a normal ebb and flow to it, but if you notice over the longer term, it still trends upward. So that's why I say for the vast majority of you guys who are watching this, don't worry about these prices when you see them dropping. You're going to see your account balance drop for some of this stuff, like right here. It'll drop from here, let's just say April 18 down to this low point of May 3rd. Your account balance probably lost value at that point in time. But from right there up to here, May 14, the price went back up, and it went back up to a level that's above where it was at before you started losing over here. So, and that was only in the course of 2 weeks. So that's an example of why don't get caught up worrying about what's going on with your account in over a course of a single day, a single week, or even a couple of weeks. There's a lot that can go on, and there are a lot of reasons why things happen. If you don't understand why why the price is changing in one direction or another, best advice I can give you is don't do anything at all. Unless you have a really good solid answer for why this is happening or why that's happening, odds are if you do make any kind of a move based on the price is changing and it's affecting your balance, and you're getting addicted to the always seeing your balance grow, well, guess what? You're going to make some really bad decisions. Trust me on this. I've been doing this for a good 16 years now, and I've made plenty of those same mistakes myself. I can practically write the book on what mistakes cause what impacts. So, and I can't tell you enough how important it is. Just stay where you are unless you know what you're dealing with. Let someone like myself who actually understands this stuff and has a lot of experience with it, and actually has a passion for doing analysis on all this kind of stuff, let us worry about figuring out what really is going on, and maybe we can bring some reason to you, and and then you make it your decision on whether you want to buy or not buy whatever arguments I might have or anyone else might have. It doesn't matter if it's me or some expert, whether the expert is in quotes or not, that you might see on CNBC or elsewhere. But as you see, though, right at the moment, the S&P 500 is in a range that I would call very reasonably priced. It's in the upper range, the upper end of what I call the reasonable price range, which are these two solid lines I just drew. But like I mentioned, the yellow line up here is where we're heading in the next year. So it's going to keep trending upward over the coming quarters. You don't want to miss out on that. All right. Let's move back to our. All right, so that's where these valuations are. That kind of gives you, and hopefully the chart gave you a really good idea of what these numbers all look like on the actual chart. If you have any questions on that, please share them. They're with me, whether it's on the YouTube page or in the TSP group. I want to make sure you understand that clearly. Let's move on now. Forward earnings growth projections. Okay, what this is, the importance of this to me is how much growth are we expecting over the next year and in the next quarter. And these are the, if you might, I don't know, if you pay attention, you might notice that these numbers look awfully familiar compared to the other ones. And there's a reason for that. It's because these are the same numbers that are driving the other ones you just saw. So 27, 30, 74 is this number right here. What I do is I round these numbers to the nearest 5. And then you'll notice 12-month future value is 3120, 3121. That's the nearest 5. So that's where all this information comes from. Now, the forward projections, where this table is useful to me. Next quarter, we should see about 5%, 5.5% growth compared to the last quarter. Double check, make sure I'm looking at this right. Yeah, which I believe will be. Oh wait, I gotta double check my numbers, but I want to say this is a comparison of the 2883 to. The numbers don't quite look right for that. 775, 74, 622, 85. Okay, so that's my year over year. And 2883, 63 divided by 2730. 74. Okay, yeah, that's the 5.6. So my 12-month figure here, the baseline value, what is it saying? That it should climb 5.5% over the next quarter, and then by 6 months from now, it should be up 9.75%. So we're going to get the strongest growth right here, out between these two quarters, and then it'll taper off. These are larger numbers, but they're all relative to the same baseline here. So 5.5, 9.75, between 11.75% and 12%, and then a little over 14.25% a year from now. So there's plenty of growth to be had in stocks over the next year, as you see, or expected to be seen, and the majority of it's going to be seen right here in this this next quarter. Looking at a quarter by quarter basis, what this is 24.5%. This is a comparison of the 775.74 to the same quarter a year ago, which is 4 quarters prior. So this is the quarter 1, 2, 3, 4, or 4 quarters ago. This is so 24% better than the same quarter report last year. The reason we do this is because companies they tend to be cyclical in nature as far as earnings are concerned. A prime example of that is H&R Block or HRB. If you take a look at their quarterly earnings data, you'll see that they'll report like 3 consecutive quarters of underwater earnings, or basically they're working in the red, where they're actually it costs them more to operate than they actually earn. And then when tax season comes around, when they get all their revenue, they'll have a very large positive report that particular quarter, and that one positive quarter more than makes up for all of the red in the other 3 quarters. So they still report positive results over the course of a fiscal year by doing that. And it's not a fair comparison to, let's say, to compare their 4th quarter to their 3rd quarter or whatever it is. I don't remember what fiscal quarter is their tax season quarter, because every company has their own fiscal year. They don't all start and end on the same date or even the same month. So just keep that in mind. There's a cyclical effect to earnings, and that's why we look at year over year, which is what the YY here means. So at the moment, 24.5% growth over the next quarter. It should slow down some to 17.3%. 2 quarters from now, and then after March of 2019, in the April to September timeframe, it should slow down into the 8 to 9% range. What happens beyond that, I don't have information on yet. We'll find out once at the end of next quarter, and we'll see how the 24.5% actually did, once the end of December comes around. All right, so that's why that's what this table means to me. And also, speaking of that, these numbers here are also an estimate of how many points I expect the baseline value of the index to go up by this particular quarter. So as you see, it's going to be the largest growth basically to my base this quarter coming up, and then it'll slow down but still be pretty strong in January through March. Then it'll slow down quite a bit in April to June, and then it'll pick back up slightly in the July to September timeframe of 2019. All right, moving on. Now we're looking at historical S&P 500 price versus earnings data. Here's another thing that often gets talked about, where there are always accusations that stocks are overpriced, or they're adequately priced, or whatever the case may be. This table is my attempt to sort out the fact from the fiction. Now, there's a caveat to this table here, and this is my newest table that I just added to my spreadsheet in more recent. I think this over the more recent quarters. Even more recently, just within the last week, I've been kind of playing around with what data points I want to look at. So this is always a work in progress. It's not set in stone that I'm going to even use these same data points in the future. I might decide to even add more. I don't know, but and that's kind of how an analytical kind of spreadsheet works. Is you start from the basics, and then you start looking at that data and figuring out what's this data, what is this information telling me, what questions do I have that this data might be able to give me answers to. So this is my most recent personal question that I have about things, and an attempt to give a good answer to that. So the left side of the table here is the S&P 500's actual close at the end of each quarter, as you see here. This column here tells you what the index actually did during that particular quarter. So in relation to the previous quarter. So if you look at this most recently reported quarter, we had a very strong number of over 7% growth from the end of June. So it was a very strongly positive quarter. Be great if we could see that all the time, but like I said, don't expect that to last much longer. We're in a very reasonably priced market right now, and at the end of June we were still in an underpriced market. We hadn't recovered yet from the effects of the correction that occurred at the beginning of this year. Speaking of that correction that occurred this year, if I go back to the chart you see here, right here, coming down is this is the correction where we had a 10% or greater drop. And if you see, it took all the way up until about this point here in August to completely recover, or to climb back above the pre-correction high. Now, prior to that point, my data that the same numbers you looked at that point in time, this was a mostly reasonably priced market up to around here, at the end of December, or the end of the calendar year for 2017. Then, as you notice, right at the beginning of January, prices shot up. There were no earnings reported yet to help justify that, though. People were just getting a little over eager to buy up what earnings were expected to be reported at that time. So what they ended up doing was push the price up so quickly that end of January, a good chunk of the index had already reported earnings that quarter, but a pretty good number of others still had not reported. And at one point in time there, the number or the price of the index got to about twice the gap between my white line and my yellow line. In other words, when it really should only be about half the distance, not twice. So that tells me that it was an overpriced market at this point in time. It eventually recovered though and got back to where a more normal figure is right around this area here. It's been staying mostly normal since then. All right, so strong positive quarter. Say don't expect much more. Anywhere in the 1 to 3% range, or I would say more like 2 to 3% range per quarter would be a more reasonable long-term type of number. Though it's not uncommon to see a little bit higher. Like as you see, it has some 3 pluses here, had a 5.5 there, over 6 here. I only had one negative quarter in the last, over the time that I've been looking at it, and that was the end of March, or the end of the first quarter this year, and that was because of the correction. 12-month performance, as you see, it's been growing. It's a little bit up and down, but mostly been in the double digits for ever since the first quarter 2017. And an attempt to smooth out this information so it's not quite as volatile, I added a 24-month figure here to show how much has it actually grown over a 24-month period instead of 12. Because in general, when you're dealing with numbers, doesn't matter if it's economic reports or earnings reports or whatever, account growth, your account balance changes. The shorter the time frame you're working with, the more volatile it's going to be. So it might be all over the place on a more short-term basis, but over a longer-term basis, it'll tend to have a more smoothed-out effect. And that's what the 24-month figure here was meant to do, is to give me a little bit more smooth figure to work with. As you see, we had 3 quarters in a row of about in the 20 to 30-ish growth rate range for a 24-month period, but this last quarter it pushed it up to over 34%. That's a very healthy rate to be growing at for over the course of an entire year. 4 quarters is a full year, and 24-month growth rate, that's 2 full years. So just think if you had 15 to 17% gains in the last 2 years, if you weren't in stock funds during that time, you missed out on a lot of potential gains. That's why we always say don't go flee into the G fund if you don't know what you're dealing with, and don't stay in the G fund because you're afraid you're going to lose money. Because I guarantee you, if you do make those kind of moves, you're going to lose money. You just won't realize you'll lose it. All right, so on the other right side of this is my earnings growth information for the S&P 500. Now, this information here is pretty much the same thing. It's just comparing this 2138 number to the 2111. The quarterly, it's 584 to 536. So, as you see, it's another volatile figure here. We got as low as 4.28% in fourth quarter 2017, and in the last 3 quarters have been really strong. 18 and a quarter, 27 and a quarter, 27 and a half. 3 very strong numbers there. Now, look at the 12-month figures. A little more smoothed out, quite a bit more smoothed out, isn't it? 8.13%, 7.95, and then it picked up, but it's not as profound a difference as you see here, not as wild either. And I only have one data point to work with so far on the 24-month performance for earnings. This has a lot to do with the fact that S&P 500's price is based on both trailing and forward earnings data. And, well, earnings data over here is only the trailing side. It doesn't show anything about forward expectations. But now, what we basically have here is they have just about 29% growth rate over the last 2 years. That's pretty close to what the index has been doing in terms of actual price performance. So that's pretty good. But again, remember, I just mentioned the price accounts for both trailing and forward earnings, while this is just trailing earnings only. So there are going to be deviations between what you see here on the left side versus what you see here on the right side. Whenever we have expectations for stronger growth than what is already being seen, you're going to see the price side go up faster than the earnings side on the right. And if earnings start to slow down, you're going to see the earnings side more than likely, or the price side here, fall, or at least maybe even start to grow at a slower rate than the right side. So, but what we're really looking for here is some sort of consistency, to really get a better estimate of the value of the index. And I don't think that price to earnings ratios are a very valuable metric to use. As you see, depending on what you're looking at, they can be all over the place. There's a long-term price to earnings ratio called the CAPE ratio. It's a cyclically adjusted price to earnings ratio. That takes a 10-year look at trailing earnings, basically, and then it compares the price performance versus those earnings. If you see anybody posting stuff about how the market's overvalued, they're probably looking at this CAPE ratio. It's a ratio that I personally think is ridiculous to pay attention to. Just my own opinion. I guess it can be useful to other people, but I don't have a long-term, like a 10-year long investment time horizon like some of these people do. So, but my point with that is, from my perspective, if it can be in an overvalued, or if it can be giving overvalued indications for quite an extended time before the markets actually show that it's true, then it's probably not a reliable indicator for me. Same goes with price to earnings ratios. When you're dealing with individual companies or whatnot, a general rule of thumb that's always taught is a reasonable price to earnings ratio is about 11 to 15. Or basically the price should be about 11 to 15 times higher than the earnings. But try looking at some of these bigger companies. They're very widely popular. You're going to see some astronomical price to earnings ratios that sustain themselves. Why is that? Maybe because just the basic cookie cutter information that you get is probably not reliable enough, and there's more to the picture than that. That's why. So this is my attempt to come up with something a little bit more legitimate, or something that makes more sense from my own horizons perspective, which is a shorter term view of maybe a year out, maybe within the next couple months. So this is a good work in progress. Otherwise, and as you see, I do think the index is reasonably priced, both based on this table and the previous information I showed you. All right, moving on to bond yields. I have two slides here for bond yields. We just finished quarter three, and this is about quarter three, but I left the Q2 information in here so you can get an idea of how much different the bond yield chart looks today compared to what the same chart looked like 3 months ago at the end of quarter two. Another explanation here that I'm going to give you is, which I've given before, is banks or lending institutions tend to borrow money themselves on the short end of this spectrum here, and they tend to lend it out to others on the longer end. Not always the case, but that's more often than not, how things work. Like a 30-year bond, that should look kind of familiar to you. How long is your home mortgage for? Probably 30 years. If you're a homeowner. How long is your car loan for? It's probably about 5 years, give or take. Well, these are both probably based on these bond rates that you see right here to some extent. So when these bond yields go up, Now, mortgage rates or auto loan rates are probably going to also go up. When these go down, those same lending rates are probably going to go down. Same thing works for when banks borrow money on this end. Now, what they do is they want to leverage their profits. Let's say they have a revenue base of let's say 200, or I'll just say $20 million worth of home mortgage loans, where they collect interest off of. They're basically getting a regular income or revenue stream from the interest that gets paid on those loans that they've given out. But here's a problem. Some of these loans are going to expire, which is going to decrease the revenue stream. And they also have different rates that they're given out at. So what they'll do, if they might only have a certain amount of money that they have available or set aside for purposes of lending to their customers. In order to make available more money to increase that revenue stream, they'll try to leverage their profits by borrowing on the much shorter term, like anywhere in this 1 month up to 2 year, for example, or maybe even 3. It doesn't matter. Whatever the duration is, and then all the interest they collect off of this larger group of people here, they'll pay off these shorter term loans quickly, and then they can keep repeating the process and keeping the longer term customers funneling in over here and increasing their longer term revenue stream. So that's why there's always an interest in bond yield curve, and whether it's a normal looking curve like right now where it has a slope, an upward looking slope like this, or if it has a flat where it goes more straight across, or if it has an inversion where the shorter term yields tend to be the higher rate and the long term yields tend to be lower. So it'll have more of that kind of look to it, or even kind of a wavy kind of look like that, you'll see. Because usually when the bond yield when bond yields invert, and there's 2 data points they're mainly looking at. Most people do. Not everybody, and there are arguments about how effective it is, but a lot of investors will look at this 2-year and compare it to the 10-year. So looking over here at this table, we had, and at the end of Q2, we had a 2.25% rate for the 2-year bond, and then a 2.85 for the 10-year. When that inverts, generally in past history, recessions, or actually, I'll just say the stock prices tend to top out anywhere between 9 months and maybe 2 years after the first inversion happens, and that also starts a recession. Recession and bear market are 2 completely different animals. A lot of people like to use them interchangeably, but they are actually 2 completely different things. Okay, so recession, by definition, is 2 consecutive quarters of negative GDP growth. GDP looks only at trailing what was already output by the greater economy. GDP factors in publicly traded companies, factors private companies, little mom and pop businesses and everyone in between, and it also factors in the government. Anybody or any company that produces goods or services toward the U.S. economy factors into GDP. Stock prices, however, their only real concern is with publicly traded companies. Hey, if I'm going to invest money in Apple, I want to know what Apple's growth prospect is. I don't care what's going on with some other company that has nothing to do with Apple, unless what they're doing has an impact on Apple at some point. Then that does impact their value as far as I'm concerned. But that's my point. When you're buying stocks, you're buying into companies. And you're buying into companies with the expectations that that company or those companies, whichever applies, is or are going to grow their earnings over whatever period of time you're looking for. That period of time, it doesn't matter if you're looking for 1 year, 1 year from now, 2 years from now, 10 years from now, 30 years from now. Whatever it is, you have an expectation that their price or value is going to go up. Their value will only go up if their earnings go up. Now, there are other things in there that can influence as well, but That's kind of what I'm getting at here. Now let's looking at the Q2 versus Q3 bond yields. This is what we have now is at the end of the quarter that just ended. We still have a very healthy looking bond yield, so it is still cost effective for banks to borrow on this short end and lend out on the longer end. If you see the yields have gone up some. The 10-year did climb 20 basis points to 3.05%, and the 2-year did climb another 30 points to 281. So the yield curve, as far as the 2-year versus 10-year, it is declining, but it is still positive. It's we don't have an inversion, and right now bond yields are quite a bit lower still, regardless than what they traditionally are when bear markets begin. Usually when you have a bear market, the very start of a bear market, these bond yields will get all the way up to 5, even 6%. And stock earnings will just slow down to the point where they just don't look as attractive to the more savvy investors, and it starts telling the savvy investors, hey, my money's better invested in bonds because I can get a better return out of bonds. They aren't moving out of stocks because they are afraid that they're going to lose money in the stocks. They're moving out of stocks because they can just get a better performance out of bonds than they can from their stocks when that does happen. And that's what we're trying to look for here. Also, I'm going to give another caveat here with bond yields. Just because, even if an inversion does occur, like I say, there does tend to be lag between when an inversion occurs and when a recession or bear market begins. And there's not even a guarantee that when an inversion occurs that a bear market really will begin in the future, the coming time, whatever, or that a recession or a bear market occur because of the bond yield data. Keep in mind there are plenty of funding sources that banks and governments can use to borrow their funds for their short-term funds from. So when these short-term funds rates get higher to the point where they're just as high as here, and it becomes and there's more involved in there. Hey, how many of these longer-term loans are close to maturing? How many of them are about the midpoint? How many of them are a long way from maturing? Because the ones that are a lot further out are going to have a much larger revenue stream and be around a lot longer than the ones that are getting ready to expire or get paid off, whatever. But so just because an inversion occurs doesn't necessarily mean that it's not cost effective for them to continue to borrow, at these lower rates. Also, like I mentioned, there are other funding sources they can use. They could use German Bundesliga or what we call the German Bund, which is basically Germany's version of the Treasury yield, the U.S. Treasury note. There are other countries that sell bonds. There are corporations that sell bonds, or on all different rates. When you're dealing with, let's just say, the foreign bonds, then foreign currency exchange rates also start coming into the picture. And there are a lot of calculations involved, but believe me, I'm sure these big companies have analysts looking at all that information and figuring out, trying to arbitrage this information and hey, how can I get the best bang for my buck? Where's the best place to borrow this money from that I want to get it, and so I can lend it out to others, and for the most cost-effective way of making a profit. So there's a lot to that, but right now, as you see here, we do have at least a healthy enough bond yield curve. It is flattening, yes. It's not anything alarming at the moment to me, but it is something that, hey, just keep your eyes on. And like I say, bond yields are still pretty darn low. They're still barely a little bit more than half of what they typically are at the start of a recession. So, in other words, what I think that means is that I think stock earnings yields would have to drop more than they normally would before bond yields would really start to become a more attractive investment medium. Whether that's going to come sooner or later, and then how bad the next recession is going to be. I'm not going to get into that whole can of worms. I don't have enough of the information. I don't want to play this speculative game. But yeah, I do suspect that with lower bond yields, stock yields, stock earnings, and stock prices are going to continue to be more attractive for a longer period of time, unless those earnings and those stock earnings yields come down a little more quickly to the point where bond yields really are likely a more attractive buy. Speaking of which, there's another section here that you might be interested in: bond versus stock earnings expected yields. Now, what this boils down to is this ratio here called the Beer ratio. This is called a bond equity earnings ratio. I always get some amusement from people who aren't familiar with this stuff, but it is a legitimate investing metric that gets used. And what it's meant to do is compare as you see here, the 12-month forward earnings estimate for the S&P 500 and compare it to the 10-year Treasury notes current yield. There are different ways that it gets measured too, with depending on what source you're looking at. Some of them might only go by earnings. Some might go by what's the current price at relative to what earnings are expected to be 12 months from now, or what, so they can vary. But by my process, I have a 14.31% growth rate expected in the S&P 500 over the next year, and 10-year note is only at 3.05, as you saw in the last slide, which means that stocks are still strongly favorable over bonds. So this comes out to a ratio of 82.43% stocks and 17.57% bonds. That's what it looks like to me should be the ideal distribution for anyone who wants a more market-sensitive balance between stock and bonds. In other words, if you're a TSP investor, you want to have something in all the funds. Based on this information, I would recommend you have somewhere between 80 and 85% of your money in the stock funds and 15 to 20% of it in the bond funds. If you look at my announcement post, I currently have it at the 85-15 level, and it'll give you recommendations there, what amount I think should be put in each of the funds. Keep in mind, these are, if you do follow what any of those recommendations are in that announcement post, please do so at your own risk. I am not a professional advisor. This is a hobby to me. Treat me more like a peer. I'm just somebody off the internet, a very well informed person off the internet. But however, if you follow these same data points that I do, chances are very good that you're going to be happy with the results you get, and you should be able to make smarter investment decisions when you have this kind of information to work with. And that's the reason why I share this information with people. You shouldn't have to retire with not enough money in your account to survive off of, and then the next thing you know, have to spend your 60s and 70s and whatever, maybe being a door greeter at Walmart or staying in a career job longer than you really want to, and not being able to enjoy the latter part of your life. So, please invest wisely. Don't make ill-advised moves just because you see your account doing this or that. Seek out the answers. Why is this doing this first? And, we're here to help you. All right. Now, last slide I'm going to show you though is the constituent changes for the S&P 500. There were only three companies that were replaced in the index this quarter, and all three of them were because of mergers and acquisitions. The first one that happened occurred on July 2nd. That was Dr. Pepper Snapple Group. They merged with Keurig Green Mountain. Now, those are both publicly traded companies, but Keurig Green Mountain has Keurig Green Mountain used to be publicly held, but they became private, from what I recall. But since Keurig Green Mountain basically controls more than 50% of that partnership they have there, Dr. Pepper is no longer eligible to be listed in the S&P 500. So they were replaced by Copart Incorporated, or CPRT, which is an industrials and diversified support services company. The other two that occurred this quarter were two acquisitions. GGP, which was acquired by Brookfield Property Partners LP. They were replaced by Arista Networks Incorporated, which is a communications equipment company in the technology sector. And finally, mid-September, XL Group got acquired by AXA SA. They were replaced by WellCare Health Plans Incorporated, which is a managed healthcare company. Over the last few years, normally what I've been seeing is about two dozen or so constituent changes in the index per year. Up until the midpoint of this year, we were at 11 companies replaced, which would have put us on track to be right in that same ballpark, in the 20 to 25 range, and not far off what has historically been happening over the last few years. Only 3 changes this quarter is actually a slow rate compared to what we've been seeing. So normally you might see a good like twice this amount on a typical quarter. So, and this does bring me to another point here. With when you're dealing with stock index funds, like you are dealing with in the Thrift Savings Plan and many other retirement plans, you have 500 companies in the S&P 500. When a good 25 of them are always getting replaced every single year, when one of them gets weak, let's just say if one company in the index goes bankrupt, it's not going to hurt the index itself. The Standard & Poor's is just going to replace that bad company with a good company that is likely to keep pushing that index's value upward. Most people will have a hard time with this concept, though, because they usually hear that, well, what if I put my money in a certain company and they go bankrupt? Yeah, you're going to lose probably all of your money unless you're a preferred shareholder. But when it comes to stock index funds, they're designed to always grow long term, and there are safeguards in there to prevent that from happening that individual companies don't have available to them. So, they say if you're in index funds, a long-term 100% stock fund buy and hold type of view, you're going to get guaranteed good results. You'll get better results even if a recession and bear market come and cause your account balance to crash, and it goes back up, than if you move over to the G fund and stay in the G fund for many years. G fund historically only is going to grow about 2-3%, maybe 4%, depending on what the bond yields are at any point in time. And F fund is, I think historically in the same area. I'd have to go on the TSP website to actually look up that information, but the CNS funds, the S&P 500 fund, and then the one that the S fund follows, which is Dow Jones U.S. Total Completion Index. Those two, they have numerous companies in there, and they have long-term growth rates of over, I think, 7 to 8%. Over the last 10-year period, and that includes part of the Great Recession factored into that. So if you consider long-term performance, you can get 7-8%, even more out of stock funds versus 2-3-4% out of bonds that are quote-unquote safer. Which one do you think is really safer? When you get one that's barely keeping up with inflation, or one that's tripling or quadrupling the inflation rate? Or at least doubling it. You're going to see a lot of volatility, and what I call volatility is what most people equate to risk. Or I'll look at the other way around. The risk that you assume by being in stocks, or at least stock index funds, is much more often nothing more than volatility, the wildness of price swings. So the more volatility you can learn to handle taking, the better off you're going to be over the long term, is what I'm getting at here. I do recommend you still stick within whatever range you're comfortable with, but my goal is to make you comfortable with being willing to accept greater risk than you do now. If you're a know-nothing type investor and you're maybe exclusively, you're heavily in the G fund as a TSP investor. So this is going to conclude my my presentation on this one. I normally would cover the sector and index specific details that I did cover in the previous quarter's presentation, but like I said, the GICS industry reclassification that just happened this weekend or this Friday, it basically created a mess for my spreadsheet where I have to compile data based on trailing information, and then in order to get the forward expectations, I need to do all my reorganization on my spreadsheet first, and then compile the forward data. So I'm not gonna go over any of that stuff like I did last time, but maybe next quarter, once I've already finished reorganizing the companies that got affected by this change, and I'll have actually trailing and forward data that I can actually work with, and I might include that in the next presentation, or at least in a quarter, and in that case it'll be also end of year presentation. All right, that's all I have for now. I know it's probably went a little bit long for some of you guys. Hopefully you got a lot of good information out of it though, and a lot of good education from it. Please share whatever comments or questions you might have again in the comment section of my YouTube here, or discuss it in the group. Thanks a lot. Have a good day.